Hi, I'm Bert Nussbaumer from macrobeat.co.uk. Happy New Year to all of you and all the very best for 2021, obviously. The year really kicked off in a very unusual, busy fashion with the Senate runoff in the US in Georgia on January the 5th. Then obviously all the events on January 6th in DC, which I'm sure all of you are very familiar with. The market was actually very resilient on the day when all kicked off in DC, and the Dow only dropped a brief 250 points from actually a 600-point rally on that day. In effect, the same, hardly any reaction in terms of a big risk-off move, which in past years would for sure have happened. Not sure why that was, whether the sort of Democratic win on the Senate is giving this sort of support to markets in general, as we expect all the big fiscal tab to be open, or if the market just never really was worried that anything is going to go out of hand. But anyway, there was really hardly any reaction from that. The one thing that did happen is obviously the win of the Democrats in the Georgia Senate and now taking the Senate. We've seen US bonds selling off, something I've been writing about in December in my 2-cent piece. No surprise there. We've broken the 1% on the 10-year, rallied as high as 1.1% this morning. So obviously the market is expecting a big fiscal stimulus from the Biden administration, which sort of scares obviously the bond market somewhat. The equity market did obviously welcome the Democratic win of the Senate, and we've seen an extended rally again from already very elevated levels. In the last maybe 24 hours, that sort of started to run out of steam a little bit, as I think the backup on the yield side is maybe starting to throw a bit of a curveball into the market. I don't expect the current level to already scare the equity market, but the dollar definitely already had a bit of a wobble yesterday. We've seen dollar rallying, dollar rand, dollar max, dollar CNA, so all the first dollars that actually sold off in the back end of last year to squeeze higher. G10 starting to back up a little bit on the dollar side. So there's clearly the market is taking note of what we see on the yield side. On the flip side, as I said, the equity market is preparing for what looks like the Democrats rolling out the double whammy, which is $2,000 check, as well as a $3 trillion stimulus package. The very interesting part would be how will the market react, or in terms of what they expect from the Fed, given the Fed in its economic projection has a stimulus of $1 trillion, and now it's suddenly going to be a $3 trillion. So do we see an early sort of taper tantrum? I wouldn't rule it out, but let's go into the slides. The first slide I have here is the EU versus US data surprise index. What we see just of late, the European data start to surprise on the downside. The latest data in the US is not in here, but you already see the blue line stabilize. And actually, if we had the latest data in there, it would actually start to turn up, which to me would probably mean that maybe the euro starts to look a little bit rich at 123, 123.5, and it's probably at risk of grinding a little bit lower. On the next slide, this is 10-year sort of yields. As we said, it's sort of backed up from the lows, finally broke the 1% handle, and I think this is definitely something we're going to be looking going forward. Non-farm payrolls today, another chance for yields to react depending on the outcome of the data. The next slide is euro dollar. We continue to press higher since the late part of 2020. We sort of topped out right now 123.5, and as I said, with the higher US yields, with the data surprise index moving again a little bit in favor of the dollar, I wouldn't be surprised if euro dollar starts to come back off from here. Next slide is the Dow. Basically, no words here. We've broken the speed line that sort of held for the last 2-3 months, new all-time highs, and really as long as we're above 30,700, there's just nothing to say. We definitely have to watch whether or not the market is getting concerned on the US yield side. Last but not least, gold, very surprising given we talk a little bit about inflation, given US inflation expectations are moving higher. Very surprised to see gold lower, and I think this dip to the middle of the Bollinger Band is a good buying opportunity for higher gold very soon. Thank you very much indeed. Bye-bye.